Good afternoon, grade 12 learners. Welcome to today's exciting session of mathematical literacy. My name is Nikki Wezulu, and remember this lesson is brought to you by the Gauteng Department of Education in collaboration with Saibono Discovery Center, and broadcast is brought to you by the Pakama Research and Development. Now, girls and boys, as we were busy in the previous weeks with finance, we are still continuing from where we left off last week. So today's focus is going to be on your UIF and taxation. Hopefully you've already done those sections in class with your teachers. So we are just going to revise them. If you didn't understand them, now you've got a chance to recap and try again. Now, just a recap from last week. Remember last week we talked about VAT, and we all agreed that VAT stands for what? It is your value added tax. Now, grade 12 learners, you are expected to know this acronym by heart. Remember, this is examinable. You can be asked this in paper 1 prelim. You can be asked this in paper 1 final exam. So you must make sure that these 2 marks, you collect it. VAT stands for value added tax. So if they want you to explain it, you will say that VAT, it is the tax that is charged on the goods and services. So if you are going to purchase any goods, the extra money, the extra percentage that they charge on those goods, it is actually your VAT. And then the other thing that you must know is that VAT in South Africa, it is calculated at 15%. So previously, in the previous years, before 2018, we used to calculate VAT using 14%. So don't be surprised when you are using old question papers or old textbooks, and then you see those textbooks mentioning VAT as 14%. That is because the 15% VAT was only implemented in 2018. But from here on, when we talk VAT, we talk about 15%. Do not be confused. And we also spoke about the VAT inclusive. That when you say the amount is VAT inclusive, it is the original amount plus the VAT of 15%. So if you go to the shops and you want to buy a pair of jeans, maybe at Mr. Price, the price that you see there on the shelf, when they say the jean is 190 rands, that 190 is already inclusive of the VAT. So the price that you pay when you purchase your goods is already inclusive of your VAT. When you talk about VAT exclusive, it is the original amount before any VAT has been added. So just to summarize this in a table, remember last week we said the first column will always represent the VAT exclusive, and then the second column would be the VAT, and then the last column would be the VAT inclusive. So here you work with the numbers. You have the numbers. A VAT exclusive, it is the original. It is the amount as a whole. And as a whole, remember, with VAT we talk about percentages. So a percentage as a whole, as the original value, we are talking 100%. And then the VAT alone, when you are going to calculate VAT on any item in South Africa today, we are talking about 15% VAT. So the percentage for VAT will be 15%. And then VAT inclusive means the original amount plus the VAT amount. And in this case, our original amount is what? It is 100%. So it is 100% plus the VAT amount, which is what? Which is 15%. And it gives you a total of what? Of 115%. So when you want the VAT inclusive, you are now going to work with the percentage of 115%. And then there's a nice formula, guys, that we learned also last week, that when you work with VAT, if you know that formula, if you make that formula your BO or your Bible, then there is no VAT question that you won't be able to answer. Just to remind ourselves again, we said that VAT formula, it is equals to the amount you have, the amount given, or the amount that you have, you multiply by the percentage that you want over the percentage that you have. Are you okay? So this is the formula that we worked with last week. So if maybe you were given the VAT exclusive amount of, let's say, 1,000 rands. And then you are required to calculate what? The VAT inclusive amount. If you are using this formula, you will say, okay, what is the amount that is given? It is 1,000 rands. Then you say 1,000 rands multiplied by, what is the percentage that I want? Remember, I want what? The VAT inclusive amount. So the percentage that I want is right here. It is 115% over. What is the percentage that I have? The percentage that I have is on top of the amount that I want. So the percentage that I want, that I have is what? It is 100%. So this divided by 100%. Then you punch this on your calculator to say 1,000 multiplied by 1.15. Remember, as Maths Lit learners, guys, you are allowed to use your calculator anytime. No one is going to judge you. Even if you want to punch 1 plus 1 and you are not sure, you do it on your calculator. You will never ever be penalized for determining the answer from the calculator. So this gives us an amount of how much? Of 1,150. So this is our VAT inclusive amount. I'm not going to dwell much into this because we spent a lot of time on this last week. I was just reminding you on where we left off. And then the second part, guys, it is the UIF. I know I touched on this when I was closing my lesson last week. Remember, you are also expected to know what is UIF. It is examinable. You can come across this question in your prelim paper 1. You can come across this question in your final exam paper 1. What you must know is that UIF, it is your unemployment insurance fund. It is a short-term relief to employees when they become unemployed or are unable to work due to maternity or illness. And then the key word here, guys, is that it provides a short-term relief. It's not something that you can rely on for life. It's only for a certain period of time, and most of the times it's only for 6 months. It's just to provide relief, to provide assistance when a person is unable to work. And then I made a perfect example last week that 2020, we saw our country going into a hard lockdown where all the shops were closed, your clothing shops, your furniture shops, your food outlets. Now, those people that are working there, remember, if they are not working, it means the shops are not making any money. So the employers are unable to pay their employees, and at the same time, the employees have families that they need to take care of. So that is where now the government came in to say all those people that were not earning income because they could not work, then they were all allowed to withdraw money from their UIF. So that is the purpose of UIF, to provide financial relief when a person is unable to work. And that is only due to valid reasons. You don't just decide that I'm not going to go to work for a month, then I'll take money from my UIF. It doesn't work like that. So in this case, if a person becomes unemployed, meaning if maybe the company closes or they become retrenched, or a person is unable to work due to maternity, because some companies, they don't have maternity benefits. If you go on maternity, they can't pay you. They need to find someone to replace you, and they can only afford to pay that person. Or if you can't work because of your illness. And then again, for this, you need to provide proof that you are really ill, and the only proof that you can provide is actually a letter from the doctor, actually a medical letter, which can be a letter from the doctor, a letter from the clinic, or a letter from the hospital. And then the UIF contribution. As an employee, if you are the one that is working, you contribute 1% of your basic salary towards the fund. And your employer must also contribute 1% towards the fund. So in total, the total that goes into the fund, it is your 1% plus the employer's 1%, and then the total that goes into the fund is what it is, 2%. So if you, let's say you are working for Checkers, on your payslip, the UIF will be calculated on your basic salary. It will be 1% of your basic salary. That is what will be reflecting on your payslip. And then the company that you are working for, which is Checkers in this instance, they will also contribute 1%. So they combine, they take your 1%, they take their 1%, combined, it goes into the UIF, which is the Unemployment Insurance Fund. It's more like money that you are putting away for rainy days that will come and help you for rainy days. And then girls and boys, you must take note again that the UIF contribution has a certain limit. So it means the amount that you contribute towards UIF, there is a limit to that amount, because there are people that are actually earning a lot of money. So if they have to contribute that much of money, the company also has to contribute that much money. It means now the payout for this person is going to be a huge amount of money, and unfortunately the fund cannot afford that kind of money. So there is a certain limit that you can only contribute UIF up to a certain amount. But this is just an extra knowledge. I don't want you to worry about it. If in the exam there is a maximum ceiling of amount, then the examiner will be specific. The examiner will mention it that so and so's UIF contribution is this person, or they will say the person is contributing towards UIF, and then in the brackets they will indicate that the maximum amount that one can contribute for this in this company is this amount. Then you know that if they've given you the maximum, let's say they say the maximum contribution is 280, and then when you calculate the person's UIF that they are supposed to pay, you find that it's actually 300. So it means to deduct UIF, you cannot deduct 300 because there's a maximum, there's a limit of how much? Of 280. So 280 is the maximum amount that you can deduct. Guys, there's a very nice question that has the UIF and it has the maximum limit. Check the 2021 Gauteng Province Paper 1 Prelim. 2021 Gauteng Province Paper 1 Prelim. In the question of taxation, I'm not sure if it's in question 1 or question 5, but there's that section of taxation. It has the UIF and it's also talking about the maximum ceiling. So that would be a perfect reference. You can go through it and then you'll understand exactly what I just explained here with regards to UIF and the maximum ceiling. I'm going to repeat this again, girls and boys and teachers at school. You do not have to worry about the maximum ceiling. You don't even have to know it. Just know that UIF contribution for the employee is 1%. UIF contribution for the employer is 1%. In total, the total sum of money that goes into the fund, it is 2%. If you have to use the maximum amount, the examiner will always guide you. So I was just sharing this extra information so that where you know that when you are given this, then you know how to tackle it in the exam. And then guys, this is some commonly used terminology that we are going to come across as we are working with UIF and when we work with taxation. The gross earnings. I think I've exhausted explaining this. When you talk about a gross earning, G, this letter G for great. It means your great earning, your great income, your great salary before any deductions. It is untouched. It is as a whole. So your salary without any deductions, it is called your gross salary. It is your gross income. It is your gross earnings. So that is your salary before any deductions. And then we have deductions. What are your deductions? It's all the amounts that are taken out from your gross salary. And then the perfect example here, it is your payee. Remember last week we said what is payee? It is the tax that you contribute. It is pay as you earn. It's called pay as you earn because the tax that you contribute, it depends on how much you are earning. There is no standard amount to say for tax, for income tax, you are paying this amount. No, it depends on how much you earn as an individual. That is why it's referred to as pay as you earn. Girls and boys, again, every time you are going to see payee, but you are expected to know what does the acronym PAYE stand for. And it stands for what? Pay as you earn. This also is examinable. You can come across something like this in the exam, your prelim paper 1 or your final exam paper 1. So when you come across things like this, I don't want you guys to be surprised. I want you to be prepared. I want you to be ready, because I'm warning you already now that these are just some of the small things. This is where you normally collect your true marks then. So you make sure that when you come across something like this, you should. And then another example of a deduction, guys, it is your UIF, your unemployment insurance fund. So these are the two examples of the deductions. Remember, we said deductions are the monies that are subtracted on your pay slip. They are subtracted from what? From your gross salary. And then the other word, it is your net pay. Normally the examiner would play some trick and say, what is the difference between your gross and your net pay? And we see a lot of things there. So when you guys are a special group, when you come across something like this, you will be ready. You tell them that net pay, it is a pay after deductions. That is how you explain your net pay. So pay after deductions. Or if you want to take it further and shine, you can say net pay, it is your gross minus your deductions. So the answer that you get, it is your net pay. So I'm explaining this because you are going to see it a lot of times. They'll say so and so has a gross income of this. So you must already know, oh, gross. It means it's a clean salary. It is a great salary. No deductions have taken place. And then, guys, these are just the two examples of deductions. They are not limited to these two. There is more. A person can be contributing towards medical aid. A person can be contributing towards UIF. A person can be paying their home loan. So there's a lot of deductions. So this is just the two. And then, guys, this is how the UIF payout works. Remember I said when a person is unable to work, maybe the company has retrenched, the company has closed down, or the person is ill, maybe because of maternity leave. The payout, it depends on how long they have been contributing to the fund. So you can't work for 5 days and then you want to go and claim for UIF. So it depends on how long you've been contributing. And then a worker accumulates UIF credits at a rate of 1 day's benefit for every 6 days that they have worked. So you guys must take note of these 6 days. It's very, very important because we are going to use it in some of our problems. So I don't want you guys to be asking me, but ma'am, where is the 6 coming from? So a worker accumulates the credits at a rate of 1 day's benefit for every 6 days. Again, girls and boys, you are not expected to know this by head. You are not. If ever you are going to need to use this, the examiner will tell you. The examiner will guide you. So here, I'm just showing you that should you ever come across something like this, then this is how you will tackle it in the exam. So for example, if a worker contributes to the fund for 6 months, 6 months, which is equivalent to 180 days, they will be able to receive the benefits for 30 days. How did we get this 30 days? You just said 180 days divided by what? Divided by 6 days. Remember, we are working with these 6 days here. So if you take 180 divided by 6, it will give you 30 days. 30 days, which is equivalent to 1 month. The worker receives a percentage of up to 58,000 of their salary for the duration of the credits. Let's say you work at Checkers and then you are earning 10,000 rand every month. And then for some reason, you are unable to work and then you need to go and claim your UIF. Then they say it's fine. We are going to pay you your UIF for 6 months. You are not going to get 10,000 every month for 6 months. No, they cannot afford that. They don't have that amount of money. You are only going to get what? Up to 58% of your salary. Up to 58, meaning that it can actually be less. You can get 50%, You can get 40%, you can get 45%, but the maximum that you can get, it is what it is, 58%. So that is the maximum that you will receive for your UIF on a monthly basis until your period expires. Again, you don't have to know this by heart. It is just the general information that you are expected to know as a MESLIT learner. Should you come across, should there be a need for you to use this in the exam, the examiner will guide you. This information will be given to you in the exam. And then here is a quick activity. Let's quickly check this. I hope you guys have your calculators, guys. We're going to do a lot of calculations today, and I'm talking big amounts. Thabo worked for George installing irrigation systems. He worked for Monday, Tuesday, and Thursday. This is how many days, guys? It is 3 days. He was earning 150 per day. Remember, per day means for 1 day. So if it's 150 for 1 day, for 3 days, it means he was earning what? 150 times 3, which is 450. After 5 years, he was retrenched. To be retrenched, it means he had to stop working. He was retrenched due to what? Due to drought. If Thabo is able to receive 58% of his salary from UIF, you see what I told you, that you will be guided. They are telling us that if he is able to receive 58% of his salary from UIF, you must determine 1. How many days of credit has Thabo accumulated? Note that 1 year is equals to 52 weeks. The fact that they've converted a year for us to weeks, it means they want us to work with weeks. Remember now, if you go back to our information, they said that a worker accumulates credits with UIF at a rate of 1 day's benefit for every 6 days that they have worked. And then I did a perfect example here that if a worker contributes for 6 months, or actually 180 days, they will be able to receive benefits for 30 days. How did I get the 30 days? I had to divide my number of days by 6. So let us check here our problem. So first of all here, we need to establish we need to establish for how many days did Thabo work. And then from there, we'll take our answer to divide by 6 so that we can get how many days of credit is he going to receive. So we agreed that he's going to work for 3 days. So it is 3 days. This is 3 days per week, guys, right? And then times by, a year has how many weeks? A year has 52 weeks. So this is 3 days in 1 year. This represents 1 year. But Thabo worked for how many years? He actually worked for 5 years. So we're going to take this multiplied by 5. And then you punch in your calculators. You say 3 multiplied by 52 multiplied by 5, which is equals to 780 days. This is the total number of days that he has worked. Guys, I hope you are also doing this on your side. And then remember to please interact with us on our WhatsApp number, which is 082 760 2630. And remember, we only accept WhatsApp messages, no phone calls, no video calls, no WhatsApp calls, no SMSs, only a WhatsApp message. So if you guys are getting the same answer as me, please send them through in our WhatsApp group. Or if you just want to comment, you can send in your comment, guys. We really appreciate your compliments. Please just make sure that you stay in touch and send in your answers. If you have questions, you send your questions, even if you can take a picture and send it in our WhatsApp group, and then we will help where we can. So guys, these are the days that he worked in total for that 5 years. But this was not the question. The question wants the days of credit. So he's going to qualify for how many days? This is where now you are going to take your 780 days and then we divide it by our value, which is what? Which is 6. So 780 and then we divide it by what? by 6. So now in total, he actually has 130 days of credit. So if he's going to claim his UIF, he will only get UIF for 130 days. I hope we are all following and we are enjoying the lesson, most importantly. And then, still the same story about Thabo. The second question is, how much will the UIF pay him in total? Remember, for UIF, he only qualifies for how many days? He qualifies for 130 days. Out of the total of 780 days that he worked, he only qualifies for 130 days. That is the credit that he has. So now we want to know how much will the UIF pay him. So let us first establish how much he was going to get if he had worked only for 130 days. Remember, how much is he earning, this person, per day? He is earning 150 per day. So we will say 150, this is per day, times, but in this case we are working with how many days? 113 days. So this is going to be equals to, remember we have our 130 days, then we times by, guys, please make sure that you punch in those calculators, ne? They don't bite. And the other thing, the calculator that you are using now should be the calculator that you'll use in the exam, because you know it, you are used to it, you guys have a working relationship. You don't want to go into the exam with a new calculator, a stranger that you don't understand, it doesn't even understand you. So it's 130 days multiplied by 150, it is 19,500. Guys, just check with me there if you are getting the same answer. It's 130 days times 150. I'm getting 19,500. But remember, this was the amount that he would get in total. But the fund cannot afford to pay him all this amount. The fund can only afford to pay what? 58%. So we need to determine 58% of this. 58%. Remember, 58% is the same as what? As 58 divided by 100, which is equals to, I hope you guys are sending in your answers, guys, please. So in total now, this will pay him how much? 11,310. This is the total payout that will come to Thabo. The second question, study Solis' payslip provided below and use it to answer the following questions. So we have a payslip here. They've already told us the name of the employee. It is Solis. And who's the employer? It is High Rise Bakery. And then the pay date is the 25th of March 2020. What is Solis' occupation or job title? He's a specialist baker. There is Solis' ID number, his tax number, his bank account number, because remember, his salary must be deposited into his bank account. And then we've got Solis' address. And then the other important information, we have the incomes. Solis' basic income, basic salary, it's how much? It's 18,090. And then the gross income is also 18,090. So the basic and the gross are the same. It means Solis is not getting any extra benefits. He's not getting any extra allowances, no overtime. It's just his salary as clean as it is. So in this case, basic and gross are the same. Now, and then we have the deductions. Remember, I said what are the deductions? All the monies that are subtracted from your pay slip, all the debts that you must pay, and they're taken out directly from your pay slip. So he contributes towards income tax. He contributes towards medical aid, towards pension fund. There's also UIF. We don't know the value of UIF, but remember what I said when you started with financial documents, that if on your financial document you see alphabets, you see the unknowns, you see letters, then you must already know that they're going to want me to find the values of those unknowns. And then there's the total deductions, which is a B. There's the net pay, which is C. Remember, we discussed the terminology and we agreed that net is what? It is your gross minus your deductions. So the change, your take home, the one that ding ding in your bank account on your phone, that is your net pay, because all the necessary deductions have been taken out. You see what I'm doing, guys? It's exactly what I've been preaching since I started with the financial documents, that when you are given a document, before you even go to the questions, you identify the type of document that you are working with. In this case, it's a payslip, and you read out all the important information. You check for all the missing information. In this case, it is our UIF, total deductions, and our net pay. And once you can see what you have and what you need, it means now you are armed. You can go for war. Where is your war? The questions, and you are going to be able to answer those questions. And I said again that all your answers are always in your financial document. You never have to go and look somewhere. You never have to think. Your answers are always in your financial document. So here they want us to find the value of A, B, and C. Let us start with our A. What is A? A is our UIF. And how do we determine the UIF? Remember, we said what? We said UIF, it is actually 1% of the basic salary. That is what we said. So I'm going to write it down again. UIF, it is 1% of what? Of the basic. That is how you will always calculate your UIF. So wherever you go, whether you go to KZN, you go to Limpopo, Northern Cape, when you calculate UIF, it is always 1% of the basic salary. Now, how do you write 1% as a percentage? You can just say 1 over 100 times by. Of means times. What is our basic salary? It is 18,090. Guys, I want you to do this one quickly and then send through your answers in our WhatsApp chat. I'm going to call in your name. If you send us an answer, remember to also mention your name and which school are you sending us from, so we can give you a special shout out, because you are a very special somebody. Did you guys get it? Guys, did you get it? Because now my calculator is performing for me, and I thought we had a special relationship with this calculator. I mean, we've come very far. We've been together for years. Guys, do you have the answers there? I don't know what's happening here with my calculator. It's just giving me an error. But I hope yours is not disappointing you from your side then. I'm getting 180 and 90 cents. It's something that I could have thought about, but it's fine. Because I'm a Meslit teacher, I'm allowed to depend on my calculator. So the answer that I'm getting is 190 and 90 cents. So that is our UIF payment. I hope you guys also got the same answer there. So I'm gonna write it here. It's 118 and 90 cents. That is the value of A. And now we need to find the value of B. And what is B, guys? B is our total deductions. And this is the section of our deduction. It means to find B, you must add this plus this plus this plus that. So I want you guys to do that quickly on your side, on your calculators. Add all your deductions and give me the total, guys. It is 2,443 and 79 plus 772 plus 415 plus, remember our UIF there at A, we now have a value. It's 180 and 90 cents. And then it gives us a total of how much? Of 3,811 and 69 cents. So this is the total deductions from Soli's payslip. And then now we want the value of C. What is the value of C, guys? C is our net pay. And remember, we agreed that what is net? How do you determine net? Net is actually equals to what? It is equals to your gross minus your deductions. So that is the formula that you are going to use when you calculate your net. Now, girls and boys, I want you guys to do this one. I'm just going to give you about 20 seconds. Do it quickly and send in your answers in the group. I'm going to give you guys a very special shout out. Don't forget to mention your name and the name of your school. So just 20 seconds, and then we'll be back to discuss the solution.
Dreams. What is your dream? Yini iphupho lakho? Not your parents' dreams, not your mom's dream for your life. What is your dream? Is it to get a bursary? Is it to study science? Is it to become a DJ? Is it to become a singer? What is your dream? Iphupho lakho. Once you have that dream, what I need you to do, I need you to write it down. Ingole mofati. Write it down, ibhale phansi, and read it each and every single day when you wake up. Read it each and every single day before you go to bed, and remind yourself of where you want to see yourself. What is your dream? Write it down, meditate on it, and go after it with everything that you have.
You have been given power to decide whether you want good results in your life, in your schoolwork, or you want bad results. As Tony Robbins said, it is in the moment of your decision that your destiny is shaped. And your destiny is shaped right now with the decisions that you are currently making in your schoolwork. So decide whether you want to be an A student and start working on it, because there is power inside of you. The infinite power is inside of you, and the time you decide to tap in that power, you will become who you want to become in your schoolwork.
Welcome back, guys. Welcome back. I hope you guys are having fun and you got the answer. Guys, we are receiving your messages. Ntombentle from PT Kulu. Nana, we are getting your messages. Thank you so much for interacting with us. And Bongiwe from Lisiba. Thank you so much, my darling. Your answers are coming through. We see your messages there. Guys, remember to keep those messages coming on our WhatsApp chat group, which is 082 760-2630. We love hearing from you guys, so please keep those messages coming. Now, guys, I'm sure by now you have your answers. Remember, we want the net, and then you said net is your gross minus your deductions. And then what is our gross? Our gross is 18. It is 18,090 minus. What is our total deduction? We calculated our deduction. Here is our deduction, which is 3,811 and 69 cents. So you punch that in your calculator. 18,090, you minus 38,111,69, and then I'm getting a total net income of how much? Of 14,278 and 31 cents. So this is the money that Mr. Soli takes home. It means when he sits and drafts his monthly budget, he budgets on 14,278, because that's the money that he receives in his bank account. That is the money that he has access to. So he budgets based on the 14,278. And then, guys, that brought us to the end of the section of UIF, value added tax, and our financial documents. And now we are coming to the real section, the most exciting section in finance, which is your taxation. So by the end of this lesson of taxation, you should be able to differentiate between the two types of taxes. We have two types of taxes, and then we'll discuss those. You should be able to understand the concept of gross income. I'm sure now you guys can explain gross income even in your sleep. You should be able to calculate taxable income. Do not panic. It's very nice. It's very exciting. It's very easy. You will see. You should be able to use the tax rate tables to calculate income tax for individuals. It's actually supposed to be tax rate tables, not just tax tables. You should be able to calculate the medical aid credits. You should be able to determine the relevant tax tables to use or the tax bracket. And lastly, you should be able to show how values on the tax rate table were calculated. Guys, I'm so excited about this section. I hope you guys are as excited because you are going to learn so much, because paying taxes is part of our everyday life. Whether you are working or not, one way or the other, you contribute towards the payment of our taxes. And remember, there's actually a department in South Africa that is responsible for the collection of our taxes. And that department is called SARS. But what does SARS stand for? It stands for what? For the South African Revenue Services. So it is a department in the government that is responsible for the collection of revenue. Revenue is all the taxes. And that money, it is used by the government to run the country. So all these things that we are seeing, the government infrastructure, the roads, the building of schools, the building of hospitals, the payment of public servants. Remember, public servants are paid by the government, but where does the government get the money from? All that money comes from the revenue, which is your income tax, which is also your value-added tax. I said all of us, one way or the other, we do contribute towards taxes. We do contribute towards revenue. Now, someone is sitting there and saying, but how, ma'am? I'm still at school. I'm not working. So how am I contributing towards tax? You are contributing to tax via the value-added tax. Remember, when you go and buy that pair of jeans, it has VAT included in it. So that is your contribution. When you go and buy a box of chocolates, that price that you are paying, it already has VAT added on it. And VAT is also what? It's also a tax. So for people that are working or for people that are earning an income, because it's not just about working, even people that are running their private businesses. So for anyone that is earning an income, they contribute towards what we call income tax. Now, when we started on the 10th of January, I said we're starting with the finance section. And I've indicated to you all the topics in finance in grade 12. And then we are done with first part. We did all the financial documents. We did your UIF. We did your VAT. Happy. Now, the second part of finance that we are going to do, it is your taxation. A very exciting session. The terminology that we are going to come across, guys, when we deal with taxation, your gross income. Guys, we've been talking about gross income the past 3 weeks, so I'm sure by now you know this. Even the net income, payee. Remember, payee is form of a tax. It is pay as you earn. It's actually a tax, income tax, and then it's pay as you earn, because the amount of tax that you pay will always depend on how much you are earning. Girls and boys, I really hope that you guys are listening. Don't rush into taking notes, because taking notes only is not going to help if you don't understand. The key here is to listen and listen to understand. If you guys want these notes, you will get them. Your teachers will get them from their subject advisors. You guys will have access to all these notes from the one that I've done from the 10th up to date. So you will be able to access them. For now, I just want you guys to listen to me and understand, because some of these questions you will be asked in the final exam, and if you are not listening, you might not be able to remember. And then payslip, guys, we spoke about payslip. We even agreed that the other word for payslip, it is actually a salary advice or a salary slip. So in the question paper, you see a payslip, you see a salary advice, you see a salary slip, same WhatsApp group. And then a salary, the money that you earn when you are working. And then tax, also taxable income. There's actually many more ways that you're going to come across that you've never seen in your life, like your rebates, your threshold, your medical aid tax credit. So all those exciting ways, you are going to come across them as we go deeper into the section of taxation. Now, this is a taxation flow chart. The section is actually called what? Taxation, and it is divided into two parts. Tax has two parts. The first part, it is your VAT, and then the second part, it is your income tax in Mathslit. We've already done the section of VAT, guys. We've over-exhausted it. Value added tax, it is calculated at 15%. We have items that are exclusive of VAT. We have items that are inclusive of VAT. And then remember what I didn't mention today, we have items that are exempted from VAT, meaning that you don't pay VAT for any of those items. And those are your basic need items, like your sanitary pads, your fresh fruits and vegetables, your maize meal, your cooking oil. So all those basic items, we are not paying VAT on those items. And then, guys, we have what we call what? Income tax. And then income tax, it is the tax that is contributed by the individuals that are earning an income. And then just because you are earning an income, it doesn't mean that you are liable to pay tax. So the amount of tax that you are going to pay, it is always going to depend on how much you are earning and your age and the deductions, whether you are contributing towards UIF, whether you are contributing towards pension funds, medical aid, and all those stuff. So there are so many factors that will affect the amount of income tax that you are going to contribute. So our main focus is going to be on what? On income tax. Now, when you work with income tax, these are the three important factors. Your starting point is going to be your gross income. When you work with tax, guys, we always work with annual amounts. Remember, the annual amounts means the amount per year. So even the gross income that you are going to work with is going to be an annual gross income. Meaning if they give you the gross income and they say it's a monthly gross income, immediately you must remember that, hey, I must multiply this gross income by 12 for me to get the annual gross income. So in tax, all the values must be in the annual form. Every single value in tax, as soon as they say per month, you highlight, no, I must times by 12, because tax, we only talk about annual values. And then we have what we call the non-taxable income. I actually prefer to use the word non-taxable deductions. Remember, guys, we spoke about deductions. We said deductions are the monies that are subtracted on your payslip from your gross income. So when you talk about the non-taxable deduction here, we're talking about those deductions that before you calculate your tax, you must first subtract them. So you cannot calculate tax on top of those deductions. And it is not all deductions. There's a special group of deductions that we know these ones, we must never, ever tax them. So before we can calculate an individual's tax, we must check first if a person has these deductions. If a person has those deductions, the examiner will tell you, then you must first subtract them, and then after subtracting them, the amount that is left, then you can tax that amount. And our non-taxable deductions, guys, are your pension fund, your UIF, your donation, and then sometimes your retirement annuity fund. So if you see this four, you know that before you calculate a person's tax, you must first subtract them, and the balance that you get, then you are going to calculate tax on the balance. Sometimes they will even indicate to you that a person is contributing towards medical aid. We don't care about medical aid, we tax it. Please don't make that mistake, guys. And then we have what we call a taxable income now. When you talk about taxable income, that is now the income that you are going to tax. It means now once you have taken out your non-taxable deductions, the balance that you have now, that is the balance that you are going to calculate tax on. So here, guys, the other question papers will say is non-taxable income. The other will say is non-taxable deduction. The other books will say it is tax deductible. When they say it is tax deductible, it means before you can actually calculate tax, you need to subtract them. And then I said, guys, what are those items? It is your pension fund, it is your UIF, it is your donations, it is also your retirement annuity fund. So I brought in some cash here. It's not my money, guys. I want to make a practical example of what is a taxable income when you talk about the taxable income. So here with me, I've got 100. I hope you guys can see there. I've got 200, 250. I've got 300. I have 2 20s, which is 340. I have 2 10s, which is 360. And then 2 5s, which is 370. So I've got 370 in total. 370. So I'm just going to make it 370,000. So I've got 370,000. This is an annual amount per annum. This is what I'm getting per annum. So from this 370, I'm contributing 15 rands towards UIF. So from 370, I'm contributing 15 rands towards UIF. So let's say yes. So I'm contributing 15 rands towards UIF. And then I'm contributing, let's say, towards donations. I'm one person that likes the grown-ups. So I like the old people. So just in the corner at my street, there's an old age home there. So I've made a vow that I'm always going to donate something for that old age home. So for that old age home, I'm contributing a 10. I'm contributing a 10, and then because I've added the 3 zeros here, I'm also going to add the 3 zeros. The 3 zeros. Remember, this is what? This is UIF. And then this is what? This is donation. But I'm also contributing towards a retirement fund. And then how much am I going to contribute towards the retirement fund? I'm going to contribute 20 rands. So in this case, it will be 20,000. So remember what's happening here? The 370 was my what? It was my gross. And then from that gross, I contributed 15 for UIF. I contributed 10,000 towards donations. And then I'm contributing 20,000 towards what? A retirement annuity fund, which is RAF. Now, what is the balance? How much am I left with? I'm left with 325. So I'm left with 325,000. So what is this 325,000? This is my taxable income. So it means if you're going to calculate my tax, you are only going to calculate my tax on what? On 325,000. You will not tax the UIF. You will not tax the donations. You will not tax the retirement annuity fund, because these three are the what? They are non-taxable deductions. They are untouchable. We don't touch them. We cannot tax them. I'm going to explain to you later why is it that we don't tax them. So it means in total, if you were to calculate my non-taxable deductions, I'm actually having 13, 14, 45 rands. 45 rands goes towards my non-taxable deductions. And then when you calculate my tax now, you are going to calculate my tax on 325,000. Whether I contribute towards medical aid or I have a home loan to pay, you don't care. This, you are definitely going to tax me on this, because now you've taken out the amounts that you're not supposed to tax. So everything else that is left here, we must tax. So now this is what we call a taxable amount. That is the amount that you are going to use when you calculate an individual's tax. Guys, I hope this makes sense. I hope you understand it, because once you can grasp the concept of taxable income, then I'm telling you, the section of taxation, you are just going to run with it. Remember to keep in touch, guys. Please send in those messages. If somehow I lost you somewhere, send in your message. And then if you want me to repeat something, depending on the time that we have, guys, I will definitely attend to that. And then, guys, we have your tax threshold. I will explain that when you come to that. And then we have the tax bracket. We'll also explain that in detail when you see it on the table. Your medical credits and your rebates. Guys, again, on gross income, it is all the money that an individual earns or income that is received before any deductions. It doesn't include any deductions. We've spoken about that. It can be made up of more than just one individual salary. For example, all the money that is received from additional work. If you are doing some extra work, you have overtime, there are extra benefits, maybe car allowance, housing allowance. All those extra monies, when you combine them together, they give you your gross income. And then when we talk deductions, it is an individual is allowed to deduct certain expenses from gross income before the tax is deducted. So this is exactly what I did. I've deducted certain expenses, the retirement annuity fund, donations, UIF, I've deducted them. And then this one is now going to be taxed. Government allows these deductions because people will rely less on the government for support when they retire. Guys, this is what it means. I said to you, our non-taxable deductions, it is your pension fund, meaning that we don't tax it. We don't tax it. So how does a pension fund work? Right now, I'm working for the Department of Education. I'm a teacher. At the age of 16 or 65, I need to stop working. At that age, I'm now a pensioner. In South Africa, the pensioners are getting an old age social grant. But because all these years I've been contributing towards my pension fund, I've been saving up my money. So at the age of 65, I decided that no, I'm tired. I need to now go and rest. I retire. When I retire, I'm going to get all my money that I've been contributing for the past 20 or 30 years. And when I get it as a lump sum. It's a lot of money. It's about millions, maybe 2, maybe 3. I don't know. Let's say maybe 3 million. But when I get that 3 million, I'm not going to get it as clean as that 3 million, all of it. That amount is going to be taxed. So when I retire, that pension amount of mine is going to be taxed. That is why when you calculate somebody's tax, you are not allowed to tax the pension fund, because at a later stage, when they finally get their pension money is going to be taxed. And then you cannot tax a person twice. A person can only be taxed how much? Once. So this is the reason why we don't tax pension fund. So as I'm contributing towards pension fund, before you calculate my tax, you must subtract my pension fund. So that at the later stage, when I retire, when I take my pension money, then the government is going to tax that pension. That is why we don't tax pension money, pension fund, first of all. And then we have what? Your donations. Guys, the donations that we are talking about, it has to be towards a registered organization. A registered organization, it can be an orphanage home, it can be an old age home, it can be towards a school, it can be towards an animal shelter, as long as you are making a donation towards a registered organization. Now, what happens when you make a donation? Let's say I identify a school and then I want to make a donation to that school. Maybe I want to build a sports field for that school and provide school uniform for all the learners in that school, or I want to donate the stationery for that particular school. Remember, the schools, government schools, are the responsibilities of the government. So if you come as a rich person and say, I'm adopting this school, I will be responsible for 1, 2, 3, 4, 5 for this particular school. You are actually, in a way, saving the government, because now, instead of worrying about this school, they know that this school is well taken care of, then they can focus in other schools. Even if you can identify an old age home or an orphanage home, if you have an orphanage home, it is still the responsibility of the government. So as a rich person, if you decide to adopt a home and say, okay, for this year, I'm going to be responsible for this home, I'll make sure that the houses are cleaned, they're well renovated, these children have clothes, these children have shelter, these children have food. That orphanage, initially, it was the responsibility of the government. But now that you are here, you've taken over. It means now you've taken off the pressure from the government. Now they can focus on other things because they know that this particular home, someone is catering for that home. So as the government's way to say, we appreciate your efforts. We appreciate that you've adopted this home and you're taking care of it. What are they going to do now? They're going to reduce your tax. So it means before they calculate your tax, they're going to consider the amount of money that you've donated to that organization. So that donation amount must first be subtracted. And then they will work on your income, excluding the donations, and then calculate your tax only on that income, which in turn is going to make your tax way lesser than it was going to be if you did not make the donation. So you will see when we work with tax, we work with different brackets. So any extra amount that comes to you, it actually means more tax, because the more money you earn, the more tax you are actually going to pay. So this is the reason why we are saying that when someone contributes to us pension fund, we are not going to tax them, because at a later stage, when they claim their pension fund, they are going to be taxed. When someone contributes to us donations, we do not tax those donations, because these people are actually relieving the government. They are assisting the government. So the government's way to show gratitude, to show appreciation, is to subtract, is to excuse them from paying tax on the amount that they are contributing towards donations. And then the amount that the person can contribute towards donations, there's also a limit. Again, girls and boys, I don't want you to stress about the limit, because if there is a limit, if there should be a limit, then the examiner will guide you and tell you that a person can only be excused from being taxed on the donations, provided that they've donated up to this amount of money. Girls and boys, I really enjoyed today's lesson. I hope you guys have also enjoyed. Please, please, please join us next week as we continue with our section of taxation. Remember to stay safe, continue washing your hands, put on your mask, and keep your social distancing. We love you so much. Until we meet again next week, Monday, same time, same place. Have a great afternoon.
Excellence. Excellence is a habit. Excellence is a quality you have, a quality I have. It's a quality we have when we honor what is true to us. Yes, we are gifted differently. uNkulunkulu akasinganga ngokufana. Excellence is striving for your best. Whenever you have a particular project, test, homework, uzibuze, ask yourself, is this my best? Can I put in more effort? Excellence is striving to be in the top 1% of the area in which you are gifted. And so I challenge you, in every single thing that you do, in every single area that you're gifted in, whether it's sports, it's academic, ucula, whatever that gift is, strive for excellence.
Hi guys, it's me again. I'm so sorry I made a mistake. I thought our class was ending at 3, but it's actually ending at 3:30. So if we can quickly continue from where I left off. But before I continue, guys, with taxation, there are some questions or rather some queries with regards to your gross income, your net income, and your UIF calculation. Remember, guys, what I said, that gross, it is the great salary. So gross, it is actually your salary before any deductions. So when you're looking at this payslip, this salary here, this is the salary, the gross income, and no deductions have taken place here. So it is your clean salary. But it is not the salary that is going to come into your bank account. That is not the salary that will come to your bank account. And then we have your net pay. What is your net now? Your net is the salary that will go into your bank account. Net is what? It means it is your gross income minus your deductions. So if you want net, you will say net, it is equals to your gross minus your deductions. So if you wanted to calculate your net, in this case, your gross, it is 18,090 minus, what is your total deductions then? I don't know if you guys still had that. I think the deductions, I'm not sure what the deductions were, but let's say the deductions were 3,380. The deductions is all these amounts, 1, 2, 3, 4. You add all those values, that is your total deduction. And then to get your net, you will then say your gross, which is 18,090 minus the 3,380. Then the answer that you get there, I'm not sure what would be the answer. It should be 14,000 and something. That answer that you get there, it is your net income. Someone was asking, how do we calculate UIF? UIF, girls and boys, it is always UIF. It is always 1% of your basic. And in this case, what is our basic? Our basic, it is 18,090. So let us calculate it again. What is 1%? 1%, I like to write it as 1 over 100. What is the meaning of off? Off means times by our basic. What is our basic? Remember, in this case, our basic and gross are the same. So whether you say UIF is 1% of your basic or 1% of your gross, it doesn't matter. But in a case where you have your allowances, overtime, UIF will always be 1% of your basic. And in this case, the basic is how much? It is 18,090. So you punch in your calculators, you say 1 over 100 multiplied by 18,090. And how much are you guys getting there? 180 cents. So this, guys, is how you calculate your UIF. And then remember, I myself, as the employee of the department, I contribute 1%. My employer, which is the department, also contributes 1%. And now the total that goes into the fund, that goes to be saved, it is what? It is 2% of what? Of my basic salary. I hope that is clear, guys. And then we can move on to what we were discussing before I disturbed you guys. Yes, so I was explaining why we are not taxing pension fund, why we are not taxing donations. And then remember, guys, to keep those questions coming through our WhatsApp number. It is reflecting on your screens there. And then, guys, the pension fund and the retirement annuity fund, same WhatsApp group. The same reasons why they are not taxing pension fund, it is the same reason they are not taxing your retirement annuity fund, because your retirement annuity fund, it is the money that you are saving for when you retire. Then you will deduct that money and it will be a lump sum of money. It's a lot of money. So when you get that money, the retirement annuity fund as well, it is then, only then, that they will tax it. That is why they're not going to tax it now, and they will tax it at a later stage. And then also the case with what? With your UIF. The amount that you contribute, that 1%, before we calculate your tax, we must subtract that 1% and put it in a fund. The day you go and claim for your UIF, then when you get that money, they will tax it then. So a person cannot be taxed twice. That is the reason why we're saying UIF, retirement annuity fund, pension fund, and donations. If we see that in a story, you immediately underline them, because you know that before I calculate my tax, I must first subtract those items. Guys, keep your questions coming. We like to hear from you. Let us know if I left you behind. If you want me to explain something further, please send us a WhatsApp message. Remember, if you don't talk to us, so we won't know how to assist you. Now, guys, a taxable income. Remember, this is our taxable income, 320. And why do we say it's a taxable income? Because it is our income minus our non-taxable deductions. So our income, take out the non-taxable deductions. What you are left with? You are left with taxable income. Like it explains itself. It means it is the income where you are going to apply tax on it. So, yes, here in simpler words, in taxable income, guys, in the exam, they can ask you to explain taxable income. Then you tell them that taxable income, it is the income that is taxed. And then it is calculated by taking your gross income and subtracting any non-taxable deductions. And what are the non-taxable deductions? Your pension fund, retirement annuity fund, UIF, and your donation. So in MathsLit, we always looking out for these four. If they say a person contributes to us pension fund, we must subtract it. Retirement annuity fund, subtract. UIF, subtract. Donations, subtract. Which is exactly what we did here. We had our gross income 370, or it was 380. And then from the gross, we subtracted the non-taxable deductions, which was your retirement annuity fund and your donation. And then the balance that we were left with, which is 320, it is now what? Our taxable income. That is why they are saying for you to calculate the taxable income, guys, you are going to see this question a lot of times. If you use the previous question papers to practice, to prepare for the exam, in the exam, in your prelim, your paper 1, your prelim paper 2, they like to ask this question. They will ask you to calculate the taxable income. So you must know that to calculate your taxable income, it is your gross, subtract means minus, your non-taxable deductions. And it's only those four. So this is a simple formula to calculate your taxable income. It is your gross income. Your taxable income is equals to your gross income minus non-taxable deductions. Non-taxable deductions, UIF, pension fund, retirement annuity fund, donations, we do not tax them. So before you calculate your tax, if they tell you that a person has any of those, you first subtract them, and then the answer that you get will be your taxable income. And remember, before you calculate an individual's tax, you must make sure that that amount is in an annual form. How do you convert to an annual form? You multiply by 12. And then income tax is always calculate. Okay, guys, this is what I just said now, that your amount must always be in the annual form. When we talk about tax, we just talk annual. And then the tax rate tables that we are going to use to calculate tax, guys, they change year in, year out. So you will see the tax rate tables that we'll be working with now for 2021, 2022 will not be the same as the tax rate tables for 2020, 2021, 2019, 2020. So if you use the previous exams papers to practice, you will see that the tax rate tables, the values, they change every year. They won't be the same. And the tax rate tables are issued by SARS. Remember, what does SARS stand for again? South African Revenue Services. It is a department in government that is responsible for the collection of revenues or for the collection of taxes. Here is a quick quiz, guys. Let's do it together. So A, they say a teacher at the school may deduct his home loan before calculating tax. Is that true? Remember, before calculating tax, you subtract the non-taxable deductions. And by now, we all know what are the non-taxable deductions. It's pension fund, it's UIF, it's retirement annuity fund, it is your donation. Only home loan, medical aid, we don't even want to know. We tax them. So here, the answer is actually false. It is false. So you are not going to deduct your home loan first before you calculate tax. We are going to tax you. Then once we've taxed you, we've taxed you, yes, then you can subtract your home loan. So the statement is false. And then B, employees may deduct. Remember, guys, to deduct is to take out. Ne? Employees may deduct their medical aid contributions before calculating tax. No ways. Before we calculate tax, the only values we are going to deduct are those for what are those? Those 4 non-taxable deductions. Those are the only 4 items that we are going to subtract before we calculate tax. Even if they can tell us that this person contributes 5,000 towards medical aid, we don't care. We are going to tax them. We tax them, even if they pay medical aid, we tax them. And then I will show you as we continue with our calculations where exactly does the medical aid fit in. But as far as taxing is concerned, we tax the medical aid. So here, employees may deduct their medical aid contribution before calculating tax. A big false, guys. A big false. You don't subtract medical aid before you calculate tax. We tax the amount of medical. We tax medical aid. It is included in your taxable income. And then C, allowed expenses will only be expenses from January to December. So guys, when I said when you talk about tax is normally on an annual basis. And then the financial year for the tax period is normally from Feb this year until March the following year. That is how we calculate our financial tax year, from February this year until end of March next year, or from 1st of March this year until end of February next year. But you will see that here in our tax table. The tax year is not the same as our normal year. The tax year is not from January to December. Yes, it's 12 months, but definitely not from January to December. So here again, our statement is false. D, guys, what I'm doing actually here is a quiz. So I'm giving you guys general knowledge. This is just the general knowledge. An employee must be able to provide evidence of all the expenses if required by SARS. Guys, as employees, every year when the tax year starts, we are required to go to SARS to submit, and then they can check whether we are compliant, blah, 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 and all that. And then sometimes you find that maybe they overcharge you or they overcalculated your tax. They end up saying that you owe them. Or sometimes they can say that you were overtaxed and then they owe you. And then if maybe they select you for an audit is when they go and verify your documents, you may be asked to produce evidence of all the documents. Maybe if you are claiming for car allowance, it means now every month you need to claim transport money from your employer. So the SARS people can ask you to submit what? Proof. A proof is where you were logging in your kilometers, where did you go, and how many kilometers you traveled, meaning how much money you spent on your petrol. And sometimes again, with your medical aid, if you're contributing towards medical aid, you might be required to bring in your medical aid certificates and all that. But again, guys, you don't have to stress about all this information. This is just for general knowledge. So this is actually true. So when SARS wants proof from you, you should be able to provide them with that particular proof. And then UIF payments are not excluded from income tax calculations. Guys, remember we said before we calculate tax, we must exclude your UIF. So this is false. Here they're saying that UIF are not excluded. Actually, they are excluded. Before you can calculate tax, you must exclude your UIF. So that was just a short quiz, just a warm-up exercise. And then guys, this is an example of a tax rate table that I was talking about. Like I said, for this one is for 2021 and 2022 tax year. So this is the most recent one. So even if tax can be asked in the exam, you are going to come across a table exactly like this. You don't even have to memorize this table because it will be given to you in the exam. So let us quickly analyze our table. In this section, we have our taxable income. Remember what is our taxable income? This income that we are going to use when we calculate your tax. Remember what is our taxable income is 1 to 320. This is our taxable income. So how do we use this in the table? This taxable income, it helps us to check under which tax bracket is this person going to fall. What is the tax bracket? This, we call it a bracket. So this would be bracket number 1. This would be bracket number 2. This is bracket 3, bracket 4, bracket 5, bracket 6, up to bracket number 7. And then how do you choose the brackets? I said I have how much? 320,000. So you check in the brackets. 320,000 falls where? Does it fall in bracket 1? No, because bracket 1 can only accommodate from 1 to 216,200. So the tax rate table almost works the same way as the tariffs. Almost. Remember the water and the electricity tariffs, those tables. It's almost the same. But then you check the second bracket. The second bracket is from 216 to 337,800. And how much do we have? We have 320. So 320 does fall between these two amounts. Meaning that if we are going to calculate tax for this person, we are going to calculate it using bracket number 2. Are we okay, guys? I hope you guys are following. And then, guys, the amount of tax that you have to pay is always calculated based on the group or the bracket in which your taxable income falls. Like here, if you were to calculate my tax from this 320 that I'm earning, you would calculate it using the formula in bracket number 2, because my income, my taxable income, falls under bracket number 2. And then let's look at this example, guys. Example 1. They say Peter has an annual taxable income of 221,549. Now the question is, under which tax bracket does he fall on? So guys, you have this amount, 221,541, and then you must decide under which tax bracket. Guys, I want you guys to try this one. I'm not even going to give you that much of a time, please. I'm not going to give you that much of a time, so I hope you've got the answer now. So the 221,549, it falls under which tax bracket? They said, is it bracket 1? Definitely not 1, because 1 can only accommodate up to 216. And then let's check bracket number 2. Bracket number 2 is from 216 to 337. So 221 will definitely fall under bracket number 2. So the correct answer here, it is bracket number 2. And now, guys, before I continue, there's somebody that sent in a question. Actually, they want to know the difference between a pension fund and a retirement annuity fund. Guys, it is almost the same thing. It's just that it's different terminologies and they are used by different companies. For the government employees, the people that are working for the government, we contribute towards a pension fund. And there's a certain percentage, it's calculated at up to 7.5%. It can be less with other companies. And then your retirement annuity fund, it works also the same way. And it's mostly for people that are working maybe for your private sectors, where the employee contributes a certain percentage of their income, and then the employer also contributes a certain percentage of the employee's income, and that money goes into the fund. And when the person retires, when the person reaches the retirement age, let's say the retirement age is 60, when they stop working, then they can claim their retirement annuity fund. Even in the government, when you retire, that is when you claim your pension fund money. It means all that money that you've been contributing for the past 20 years, every single month, now you get all that money as a lump sum. It comes to you. It means you won't even have this. There won't even be a need for you to go and register for a social grant, because you have all your money that has been saved up for you for all these years. So a pension fund, guys, a retirement annuity fund, there's basically the same thing. Like I said, that for us as government employees, we use what? Pension fund. And then your other companies like your private, they use what? They use retirement annuity fund. It is the money that you are going to claim later when you retire. I hope that makes sense, guys. Okay, and then you'll always be given the percentage. The percentage is not always going to be 7.5%. It is up to 7.5%. So it can even be less. Don't worry about it. If the examiner wants you to calculate pension fund, they will give you the correct percentage to use. You must just be wise and know how to work with your percentages. And then number 2, Peter has an annual taxable income of 221,549. Now we must calculate his tax payable. Remember, what have we been doing here? We've been identifying the correct tax brackets. But now we need to calculate the tax. First of all, you ask yourself, is the amount monthly or yearly? They've said it here that it is annual. We are happy. And then they've told us that it is the taxable income. And we are also happy. We know that we don't have to stress. They've already done the work for us. Because, guys, once you see the word taxable income, even in the exam, you jump and say yes, because you know that they've already done all the work for you. Yours is just go to the table and identify the tax bracket. Now, let us check 221. It is under bracket number what? It is bracket number 2. So what you do, you are going to rewrite the formula in bracket number 2. So let's rewrite it. I'm going to write it here. It is 38,916 plus 26% of, guys, taxable income. Remember, they gave us the taxable income. And they say, what is the taxable income? It is 221,549. So when you see taxable income, you're going to write 221,549, and then above 216. Then you are going to minus. Always, you are going to minus. Go to Mpumalanga, minus. Northern Cape, minus. KZN, minus. Minus always. Minus what? 216,200. And then you close your bracket, which is equals to 38,916 plus, guys, 26%. I like to write it as 26 over 100, or you can say 0.26. And then in MathSlit, what is the meaning of? Of means times. Open the bracket. I'm going to calculate the difference already, guys. 221. I hope you guys are working it out there, because I know in your classes, either you are busy with taxation now or you are done with it. So you guys are going to be the masters of this section. 221,549 minus 216 200. And I'm getting 5,389. Girls and boys, here we use the concept of BODMAS. Please, most of you are getting this wrong in the exam because you don't apply BODMAS. You'll see people saying 38,916 plus 26%. No ways. BODMAS says what? You first work out what's inside the brackets, and then you multiply, and then the last step will be what? It will be addition. So guys, I want you to do it then. I've already tried to simplify it for you. Let's continue. I'm going to go to the answer. 38,916. I'm getting 40,306 and 74. What are you guys getting? I hope you are getting the same answer. So they gave us 3 options there. You know that feeling when you're in the exam, you are given the 3 options and then your answer is one of the options and you're like, yes, a win. It means I'm correct because now, okay, we just an issue of rounding off, guys, but our answer is correct. It's actually option number 1. So even in the exam with you guys, don't round off in the middle of your calculations. We always round off at the final answer. As you are calculating, bringing it down, include all the decimals, then you'll calculate at your final answer. So if we were to calculate Peter's annual tax, his tax that he has to pay for the year would be 40,306 and 74 cents. Guys, this is just the basics of taxation. This is just the foundation. There are still so many aspects of taxation that we are going to discuss. We're still going to talk about the tax rebates. What are they? You must understand them. We are still going to talk about the tax threshold. We are still going to talk about the medical aid tax credits. What are they? How to calculate them? And how do they benefit the taxpayers? So girls and boys, if you want to hear all about that, make sure to join us next week, guys. Same time, same place. Remember to keep safe. Always wash your hands. Social distance. Put on your mask. We love you. Have a great afternoon. Thank you.